Good morning, everybody. This is Chris Robinson, Robinson Ag Marketing with today's pre-opening grain comments for Tuesday, the 25th. Well, quiet night overnight, a little bit higher, about a 9 cent range in the beans, two in the corn, five in the wheat. I think the biggest thing people are concerned about now is do we or don't we have a deal with China? Uh, President Xi and President Trump had a phone call yesterday. Apparently, China said it was win-win. The market didn't really embrace that. The Chinese did buy, I think, two or three cargoes from the PNW yesterday, but nothing what not what they need to actually start getting after, unless they've already bought it in the futures again. People keep talking about what are they going to buy. They haven't really been voraciously going after the last 10 million metric tons. They've got a little less than two, probably close to two now, but they've got 10 more to go if they're supposed to get it done before New Year's on the buys that they promised when they had the meeting in South Korea. So that's probably what the market's going to focus on. What's the crux of the argument? Well, Japan said they would come to the aid of Taiwan if China decided to go after them, and China didn't like that. They're trying to get President Trump to tell Japan to take it back. So this is like I don't know. It's like watching middle school playground behavior by heads of state. We'll see how it all turns out. I don't know, but that's market's always looking for the next thing to worry about, and this is what it's worried about now. That's all markets do is go from one worry to another worry to another worry. Jam beans overnight up 4 cents, 11.27 and a half. The open interest in D's, there's still a pretty good boatload there. Most people think that the people will wait and roll probably in by Wednesday because Friday's first notice day. I've told my clients in the last week, as soon as those options will expire, get away from the D's futures and get into March futures. Go where there's liquidity. Um, People always get hung up in the delivery months. Just get into March. Okay, you've got the corn. You're sitting in the bin. If you want to play the delivery game, God bless you. I don't advise most people to do that. However, I do have clients that do, but in general, I think most of you should just get yourself into March for your hedges. March Chicago wheat up 1.75 cents. Again, a nickel range overnight. I think just going to wait and see if we can get any more recovery. We did have a good 52-cent rally to 4-month highs, and then we basically gave back 65% of it in several days. So we're back worrying about, are we going to hold those contract lows? You've got March trading, the low overnight was 521. Are we going to go back to the contract low at 498? I don't know, but it's only 25 cents. So with 25 cents worth of risk, you should not have 20-cent puts on, right? You should have probably 4, 5, 6 cent puts on something cheap because you're defending against the contract lows. And basically, that's what a put is. A put is a sell stop. It stops your losses on paper. You're long in the bin, right? So you need a hedge. You don't buy the hedge to make money. So I got to remind that to guys all the time. You want to make money in the cash market. So you want to you want the cash market to go high, but you need to defend rallies until you sell the grain, right? After you sell the grain, then you want to double up, get long. That's fine with me, but also guys have trouble making cash sales into 50-cent rallies. Make the cash sale into 50-cent rally, hold back 5 or 10 cents of the rally, re-own it on paper. Then you made a good cash sale, but then you only have 5 or 10 cents at risk in case we do what just happened, where you drop 35 cents after a 50-cent rally. So it's just, it's not a math problem. It's not a physics problem. It's not something you can replicate over and over again. It's good. It's just good risk management, in my opinion, after doing this for several decades. And the fat cattle, we're going to see. Fat cattle and feeder cattle were locked limit down yesterday. Are we going to continue to remain limit down? I don't know. I think the reaction was more to money flow than anything else. I mean, a lot of guys thought that we might be higher on the cattle on feed, but I think the closure of the Smithfield plant in Nebraska created this. So we're trading headlines, we're trading emotions, and you get moves like this. We did get a little bounce in hogs. April hogs up a penny, a little over a penny yesterday. Again, this is coming on the heels though of a pretty horrendous correction, right? Um, 81.10 was the low. You go back to the contract high, you know, just 2 months ago, in September 29th, we were trading 94. So from 94 to 81, you just lost 14 bucks. Are you going to get it jazzed about a $1.50 pop? I don't know. There's a lot more upside potentially right now. I would tell guys that if they did have hedges on from when we were up higher, this is when you want to roll them down. People always say, "Well, I hate options, this, that, and other thing." You've got to be disciplined in managing the value. And again, there's no math formula. There's no AI program that can tell you this is the day to roll them all down. This is the low. You've got to make a decision, and that's the second part. Most people hate making decisions, right? They don't want to. They don't want to make a decision about making a sale because they might be wrong. They don't want to make a decision about putting a hedge on because they might be wrong. You have to embrace the fact that you're probably going to be wrong anyhow. What we're trying to do is capture the meat of the move, and what we're trying to do is resist the temptation to try to be George Soros or Paul Tudor Jones and sell every high and buy every low. You are a farmer or producer. You're always bet long. What we want to do is defend the meat of the move, and we don't want to be in the crowd that's selling at the bottom third, which is where 67% of all the grain gets marketed in this country. So that's what we're trying to do. Oh, take one look at crude oil, 57.33. If it takes out 55 and change, that's going to be a new 5-year low. That's going to be all over the news. If that happens, the newspapers like screaming about multi-year lows if it happens. Now, who's going to get the credit? Who's going to get the blame? I can tell you one thing: if you're in the oil patch and if you're if you're drilling for oil, you really feel a lot better about oil when it's at 70 versus when it's at 57. Also, I think the ethanol argument does better when crude is north of 70. So throw that on a big ball of wax. We'll see what happens today. It is the week of the holiday. I'd imagine we'd have a little bit of business in the morning, then a little bit of business on the close. I would expect very, very volatile, choppy trade. Just be careful out there. All right. This is Chris. Have a good day. 312-638-8868. I am in Iowa. I am doing market to market with Paul Yeager today. We're taping it today, and they'll put it out over the holiday. Take care.